for context, and before we start the debate, I just want to briefly introduce ourselves and also the reason why we've done this report. First of all, we are a global platform for media capital investments. We at Media for Growth, we syndicate media capital deals and deploy media capital, media credits, as we call them, in consumer brands, leveraging the inventory, the advertising space of our media partners. We have a global platform of media capital investors and special programs for startups, for emerging brands, supporting them launch their first mass media campaign, as well as raise the first media capital round. So we are not just an investment platform. In fact, we actually started as a specialized program for supporting consumer brands scale and grow. And ultimately, this is the objective of Media for Growth. We want to work with consumer brands and help them scale into household names using the power of media, or what we actually call brand advertising. I have a fantastic set of speakers with me today, and they've all been selected to be part of this, what I hope to be a very insightful conversation because of their backgrounds. And I want to mention that media capital, I'm sure most of you, and hopefully most of you today are familiar with the concept, but media capital sits at this perfect intersection between venture capital, advertising, and consumer investing or startup ecosystem. So it's my pleasure to have Alex Wallace, Nico Vesche, Chris Hill, and Tim Fang that have this fantastic backgrounds in all of these three areas, because we want to provide a holistic view on this model and approach to media capital. I'm going to let them introduce themselves because they have incredible backgrounds, and I won't do it justice. And then we'll go straight into the debate. Alex, we can start with you.
I'm Alex Wallace. I'm a media advisor and an executive in residence at Progress Partners, which is an investment bank in Boston. Until a couple of years ago, I ran the media and content business at Yahoo. And before that, I spent a decade at NBC News, where I was the number 2 at NBC News and ran a bunch of the television shows. I'm really happy to be here.
Thank you, Alex. Nico, I can go over to you.
Hi, I'm Nico. Hello, everybody. I'm Nico. I'm the founder of German Media Pool. We are an independent media for equity fund based in Germany, as the name implies. We are independent. That means we're not owned by a media group, but we connect more than 40 media groups out of home, radio, TV, and print to startups. We've done about 40 investments. We've exited about half of those. Amongst those, we've had 3 IPOs. We've also had a secondary sale. So that's what I do today. But I've been in the media industry for about 20 years. Before that, I was at ITV for a while. I was at RTL for a while. I was at IBM for a while, being the media industry leader for Europe. I was at GfK, also media industry leader globally. And I also even spent a small amount of time at a US venture capital fund many, many years ago during the new economy. That's where I learned venture capital and experienced that, and then was able to combine that with media to start German Media Pool. That's me.
Thank you, Nico. And also for transparency, German Media Pool is an investor in Media for Growth, and Nico has been supporting us as we've been scaling this model also now across the US.
It's been a pleasure, Diana.
Thank you, Nico. Chris, joining us from London this time.
Hi, I'm Chris
Hi,
Hill.
Chris.
Hi, I'm Chris. I'm the managing director for Edenbase. We are an early stage venture fund headquartered here in London that focuses on late seed, early Series A investing in Europe, both the continent as well as the UK. I have my background is 20 plus years in private equity and venture, including a period of time where at Comcast Ventures, which had a strong media for equity component in our investing thesis. And so have spent time working in both consumer and enterprise investment, both in the US and now here over in Europe. And also sort of as a way of one of my points of relevance on this is I love the media for equity programs, including a recent investment we did here in Europe that was brought to us by MFG called Trip, which is a direct-to-consumer travel booking platform. And one of the reasons that we invested was because of their the Media for Equity involvement.
Thanks, Chris. Tim?
Hi there, I'm Tim. I'm the co-founder and the CEO at Airtasker. We're a marketplace for local services, and we scaled in our first market in Australia, doing a media equity deal with Seven West Ventures, which was owned by Channel 7, and had a very successful experience and a sizable exit for Seven as well. So we're now taking the Media for Equity model and scaling into the UK alongside Channel 4 Ventures, and in the United States alongside Televisa Univision, Sinclair Broadcast Group, iHeartMedia, and Mercurius Media Capital. So I'm passionate about this space and seeing some success in it, and want to keep that going.
Thanks, Tim. Yeah, I'm really looking forward to sharing that experience in a moment. I forgot to mention also the reason we started this report, and it's in fact the third edition that we are launching today. Media for Growth has only been around for less than 3 years. I think we've achieved a lot in terms of traction, companies supported, media capital raised, especially in the US. But when we started, and if we wanted to set this up as a global platform for media for equity investments, what we better understand the market that we're playing in. So back then, 3 years ago, especially even though Europe still continues to lead in terms of actual volume of media for equity investments, there was nobody at the time actually looking into the space or doing a proper industry research. So the first edition went out in 2022. Since then, a lot of the findings have been picked up about a lot of reputable publications, Financial Times, Sifted, Forbes, Campaign, etc. And really this is set to become an industry benchmark. And I'm absolutely thrilled to launch this report. I think is by far the most comprehensive research that we have done so far. I also want to thank not only the people that I have with me on the call, but all the amazing investors, VCs, media investors, founders that have shared their insights with us. There's been a lot of weeks that have gone into this report and over 500 investments analyzed, as well as the first media capital survey among fund managers. Because it's been a pretty complex decade to unpack, this particular report looks back. That's why it's also titled A Decade of Growth. We have actually seen 10 years consecutive of media for equity investments. In some cases, actually going up and up and up. Obviously, we will see that in the report, some of the reasons why in certain years the volume has been decreasing, but we are overall on a forward and ascending path moving forward. When I look at the last decade, and I think it's important to contextualize again why we're discussing media capital and what this is. It's important to look at what is happening in the venture capital landscape, especially for consumer brands that are fundraising right now. The rise of direct-to-consumer startups and the fact that these are companies that were born and completely raised on digital, as well as the shift in advertising revenues from what we normally call legacy media more into digital platforms. I think everyone is aware of the situation, even if you are not necessarily passionate about the consumer space. But in the last year, it's been particularly tough for consumer founders to raise. $1 in $16 went to consumer brands, down from $1 in $3 a decade ago. However, this doesn't mean that advertising is still not one of the most heaviest line of cost for a lot of the growth stage consumer companies. We've gone through roughly 100 K1 statements of growth stage brands to try to understand where they're spending, where the budgets go to, and majority of it goes into advertising. On average, 40% of revenue for a growth stage brand goes to marketing, in some cases even 60%. But where does the spending go? And a lot of you that are joining us coming from a media, especially media background, this doesn't come as a surprise that majority of that spending is concentrated with a few big tech platforms, right? So Amazon, Google, Facebook, TikTok, more recently, they have a concentration of over 60% of the advertising spending. Now, this is obviously quite obvious, clear that it's an increasing threat for a lot of traditional media companies that are now sort of forced to find a new way to catch digital advertisers and diversify revenue, but especially for consumer brands. And this is a topic that we would like to discuss today, and having Tim on the call can share his experience. We're seeing that the cost on digital spending is increasing and is also even less controllable. Just over the weekend, because of the Google ad outage, a lot of thousands of dollars were basically lost. And this is the actual mistake, I think, on over-indexing on a specific channel. So all these different factors, consumer spending, the rise of direct-to-consumer startups, what we're seeing in terms of shifting advertising revenues, have created, in my opinion, a perfect storm for allowing innovation to happen, disruption to happen, and especially for a model like Media Capital to grow. I hope majority of you are already familiar with what we're discussing today, but the way to think about Media Capital is a venture model which complements venture capital perfectly, right? It's not an alternative. A brand needs both cash and brand advertising to grow, that enables growth stage startups to trade equity for advertising. And this is particularly for television, print, radio, but could also be for other digital platforms. So this research, and the report will be available immediately after the webinar, was set to answer three main questions. We looked at a decade of growth. I think that raises a very important question. What returns have we seen among media companies and startups? And more importantly, why is this happening now? Why is this picking up a lot more now, especially in the US? And I would like to turn to Alex and Chris for this initial question. And what I'm going to do, we're going to pull up some very interesting findings that we gathered through the report and discuss particularly on them. So we looked at the fund managers that have been doing this over the last decade. 94% of them are actually planning to increase the allocation of media capital or maintain it in 2025. And when we look at specifically US companies, roughly 5% of their advertising revenue right now is allocated to media for equity investments. In some cases, we're talking about over $100 million. So this is not just becoming a tool for optimizing ad inventory, but it's actually part of the corporate strategy of the company. So, Alex, what do you think? Why do you think media capital is now gaining more prominence across the US as opposed to, let's say, 5 years ago? What do you think is driving that change?
I think there are a number of reasons. One, large media companies didn't need to look to alternative revenue because there was so much cash coming in. Two, they're now seeing the success that has happened in Europe and is now happening with some of the American companies. And three, large companies were not set up. NBC now has Forecast, I think it's called Forecast Ventures, to do this.
Labs, yeah.
For large companies are set up, so sales and venture are two completely different P&Ls. And trying to get two P&Ls to talk to each other and share how do you allocate that revenue is really complicated and contentious in large companies.
Chris, I'm curious also about your experience with Comcast Ventures. Fast forward 3-4 years, why do you think this is happening right now? Why is this picking up a lot more right now in the US?
Yeah, I would echo a lot of Alex's comments. I think that first and foremost, it is a need to diversify their revenue and replace some of that loss that's been occurring. And that's sort of twofold. One, their core businesses are going down. And then two, they need to find new advertisers, people who are going to become part of their platforms from a long-term perspective. And they've realized that without sort of actively being involved, the nature of some of these brands or companies to go to television advertising is going to take them a lot longer. And by sort of helping nurture their development into through Media for Equity, they can bring those companies into the ecosystem much earlier for a much longer term relationship.
Yeah, and we had this discussion before, and Nico, please also feel free to add to this, because media for equity is not necessarily new to US media companies. Investments, deals as such, or sometimes called barter agreements, were done in the past. I think we're actually witnessing right now is just the model is becoming more institutionalized, right? At the start of the year, you have a set allocation of media, which is put aside for media for equity investments. Nico, you've been doing this for 13 years with German Media Pool, a lot of investments. Europe is kind of way ahead of the curve. Do you think that seeing these returns from other European media counterparts had also something to do with the fact that this is also becoming more structured here in the US?
I mean, I think that Europe had the big advantage to kind of have a disadvantage. So in Europe, startups have a harder time finding venture capital. Media groups have been a little more anxious to, let's say, connect to companies that would otherwise only spend digital advertising and nurture those as future clients. So I think there has been a lot of pressure in Europe, maybe for longer than in the US. And that created an environment where this kind of model could be professionalized. But I think we should still be very cognizant of the fact that US media groups have also used this model in the past. During the new economy, probably every large US media group did their media for equity investments in this, first wave, boom wave, where everybody wanted to be part of the internet economy. And so I think it's a really exciting opportunity because it's very seldom that we've done something in Europe which can now translate into the US, but it's not as if we invented it in Europe and we don't want to take credit for it. And I think maybe on the contrary, I think we have a great, kind of communication going on between different media groups sharing their experiences and everybody becoming a little better at this and learning from each other. So I think that's the way to look at this.
So learning from each other, Nico, I want to stay with you on to the next finding because one of the main questions, right, of the report is what returns we've seen. And it's not just about financial returns, although 69% of the fund managers have actually shown returns that are very similar to what we normally see in traditional venture capital funds. But I think more importantly, it's also about some other strategic returns that may happen even before a liquidation event. This particular finding, I think, is very important to discuss. 56% of the fund managers have actually mentioned using this mainly for optimizing ad inventory, right? That was the key driver. Going back to German Media Pool and the success you've seen over the last decade, what returns, and not just financial returns, but what are the strategic benefits you've seen both for the fund and for your media partners?
Yeah, sure. I think there's a multitude of different benefits from a media perspective to engage in media for equity. So one of those is indeed financial returns. I think that it definitely is more from a CFO perspective and not from a sales perspective. What I mean by that is that the CFO finds big benefit in also having returns 2-3 years from the current moment. Obviously, sales is very much focused on the annual sales performance. So there is a bit of a disconnect there. But overall, for the media group, I think the returns sometimes come at times which are very practical. So in a cyclical downturn, suddenly you have a couple of exits and you have extra windfall cash coming in. That's always very great. CFOs are very happy about that. So in general, we always say, look, you're doing something also for other reasons. And you're not going to be, spending money on this. You're going to be actually getting money back. So that's the financial kind of perspective. But more importantly, probably is the strategic angle, which is media groups find that they're engaging very early in direct relationship with future emerging brands, which will become very important ad spenders in time. And so the earlier you build these relationships, the better. These are, some of the future, listed companies that will be, engaged in advertising for many, many years to come. So this is a very, very great opportunity to engage with these clients very early on, using a model that they understand. So those are two definite benefits from a media perspective.
Yeah, and I think it's also entry into new sectors. Running the survey also show that a lot of the fund managers are thinking about maybe the less obvious sectors that are overly spending or already heavy spenders on TV. I think we've seen companies from real estate business or gaming or subsectors of healthcare that are now entering this market because of media for equity investments. You mentioned something very interesting about the brands, the fact that brands understand the value of media for equity. And I think we had a very interesting debate the other day, the five of us. Digital media is always synonymous with performance media. But TV can also be a performance medium. Now, how do you go about convincing a brand, right, that was born and raised on digital channels to try out brand advertising? And Nico, you had an interesting, I think, example from some of your past companies and how that actually helped them.
Yeah, for sure. So I think, we talk to startups all the time about the value of above the line media. And one of the things that we always discuss with the founders and with the marketing officers of these companies is that there's many ways to benefit from above the line media. One way is direct traffic. So especially with TV, but it also works with other media as well. People are on their phones most of the time with a second screen. They have their laptops. And so when they see a TV ad that's engaging, they will directly go onto that startup's app or website. And that can be directly measured. So this is a direct traffic effect, which is fantastic. Also because you reach people that you wouldn't normally reach using your digital channels. So it's a whole new set of people. Second, however, it also improves the performance of your digital channels because the brand is in the people's heads. Once they see you again on one of the Meta properties or they see you on one of the Alphabet properties, they're more likely to click on your ads, especially if it's in areas which are a little bit sensitive where trust is important. I'm talking about insurtech, fintech, maybe health kind of startups. So they're above the line still conveys a lot of trust for consumers, and rightly so. I mean, these are media that have existed for decades, building their reputation.
So I want to take that thought and move over to Tim to discuss also one of the findings, but your experience when you first did your mass media campaign with Channel 7 in Australia. The research going through over 500 investments shows that this is a pretty staggering, actually, figure that 94% of these brands that raised the media capital round in the last decade are still active to date. And we will see there's a lot more other benefits. There's even a shorter path to an IPO for companies that have used not only media capital, but what we're discussing here really is brand advertising. Tim, how did you convince your board as a CEO? I think that's probably the most important job. And there's been a lot of research that shows companies that are using brand advertising, obviously they can strengthen their brand. And even when the times are hard or the prices are going up, right, that brand value still holds. How did you convince your board to first do that brand advertising campaign so early on in Airtasker's growth cycle?
Thanks, Dana. We always had a view that building our own brand was really important and not to have dependency on platforms, whether that was, startups that were building like widgets for Twitter or, I think at the time Zynga was going really turbo on, the Meta platforms, but we're always like, that's a bit shaky and you're always sort of beholden to like a singular platform. And ultimately, I think if you sort of build on those platforms, your top line is capped because that platform's got the data and they're just going to extract the profit line to the level that makes sense. So we're seeing that now with Google, for example. They're under a little bit of heat, so they're just converting all of the organic traffic into paid traffic, and I think we're seeing that sort of play out at the moment. So we did always have a view that investing in our own brand was important so that we could have independence and a direct relationship with consumers and to be in their headspace. That's in terms of why we did it so early on. We found that actually most of our strategy, inverted commas, was actually driven by necessity. And so we were raising capital, and we needed cash capital to keep building the company. And Channel 7 in Australia was willing to write the check for a Series B, but it also came with, hey, we want you to try out some of our advertising. So they were sort of doing an advertising sales play at the same time as investing cash as venture capital. And that was the thing that pushed us over the edge to go and do it. Looking back over 5 years that we were with Channel 7 and the venture team, it turned out to be awesome. So it was not easy to get we were forced into jumping off the cliff, but we managed to assemble the plane on the way down, and it turned out to be a really good move, which is why we're trying to repeat that success in the UK and in the US as well.
And Tim, you're talking about the campaign, I think was called Like a Boss, right? Back then in 2016, when you first did the deal with Channel 7. I'm going to play that video. One of the videos, I find it really hilarious. I'm going to play it now, and then I'll come back to you. I have a follow-up question for you on that.
Very 2016.
I don't know if anyone could hear the sound. If it wasn't, you should have stopped me. I will circulate the slides afterwards. It's such a great TV ad. Great creative as well. I'm not gonna play it unfortunately again right now, but yeah, it's yeah. I can guarantee the sound was great, at least on my end. I'm sorry about that.
The sound was great, Diana. It looked really great. How long was that? 20 seconds or 30 seconds, Tim?
No, I think it was 30 seconds, right?
Great.
Yeah, we actually did 45s and then cut them down to 30s and 15s. But in Australia, I think 30 and 15s the common format.
So I want to go back to a conversation we had, I think this was 3 weeks ago, where you did mention, and clearly you just stated around, media capital can be a great growth strategy, but at the same time, it has to be done at the right stage, and you do have to have a certain readiness to it from a product market fit. I think it was probably 6 years forward, right after 2016, that you launched Airtasker in the UK. You've done the deal with China 4, and last year you entered the US with the investment you mentioned at the start, Tim. How did you know that you were ready to scale into an international market? What was that sort of readiness that made you go for it?
So Airtasker is like an open community marketplace model, and it's got similar, I guess, dynamics to like a social network in the sense that the demand is customers posting jobs, and that's user-generated content, and the taskers who are making offers to do that work is also user-generated content. So we actually have like not much of an operational model. It's predominantly like an awareness and a marketing model. So the honest answer to did we know we were ready is it was really uncomfortable when we did it in the Australian market, and we managed to work that out. And that was really good motivation for us to work out our issues and scale. And equally, we feel uncomfortable doing it in the UK and the US in terms of where it is in the life cycle. But I guess we've got enough battle scars to know that doing it early isn't necessarily a bad thing, particularly in a network effect business. What I mean by that, or maybe to clarify that, is you're in a user-generated content business, it's unlikely that you are going to be ready from a product perspective because a lot of the product is the community, the user-generated content itself. And so it's inherently a chicken and egg problem, which means always on, one side of the market, you're always trying to bring the future forward so that you're doing the same and delivering to the other side of the market. So we've been scaling marketing earlier and earlier. I also think, just as an aside, investing in your brand, other than the risk dynamics on that, I don't think it's ever too early to invest into your brand, because it is an asset that is going to deliver value over a period of time. Now, that asset may not generate sufficient, not be sufficiently leveraged or utilized if you're not doing other forms of marketing. But in general, I don't think you can really waste that time of building your brand. So other than, where you're going to allocate the capital in the business, it probably makes sense to do it early.
Thanks, Tim. Chris, I want to come back to you and talk over one of the findings. And I alluded to that when we were discussing the survival rate of the startups. We've gone through, I think, roughly 286 companies that were founded between 2014 and 18, but raised media capital in the last decade. And we compared that to, I think, roughly so there's about 44 of them that IPO'd based on this particular time window. We compare them with other 44 companies that IPO'd around the same time. And there's a shorter path to the IPO by 12 months for these media companies, which, in other words, it also translates for a shorter path of liquidity for also the cash investors as well for the media investors. In terms of your portfolio companies, what you're seeing out there, are we still in that capital efficiency cycle of consumer investing, or do you see more aggressive growth and spending on media? And if so, where does brand advertising fit with some of your portfolio companies right now?
Yeah, so I think in general, we're still in a fairly conservative area, and that is just sort of a reflective of where the venture market and the industry is right now. When you look at how much money is being invested by VCs, or whether that's at a late stage or early stage. So one, it is purely reflective of the market. I think that there's some additional challenges, despite the fact that there have been some huge exits, that that the ability to IPO, if you're not IPOing a consumer brand, there's some real questions around how you actually exit in terms of who your acquirers are. There are fewer acquirers versus an enterprise software, which is why there's sometimes a leaning to that. But that being said, when you hit a direct consumer brand correctly, an Uber, an Airbnb, you are going to create the potential for creating much larger returns than, say, another SaaS software company. And I think that while in general consumer is going to be fairly conservative going forward for what we would define as traditional direct consumer, so something to call it an e-commerce or other brands, I think one area that you will see a lot of increasing amount of investing, I think it's early in the cycle, is going to be around AI-enabled consumer brands. So if you think about how mobile is responsible for the creation of an Uber or Airbnb, et cetera, over the next couple of years, you're going to see some consumer brands that are going, whether that's a digital assistant, additional pet, whatever it may be, that is going to be driven by huge, where there's going to be a lot of money because you're going to get some huge outsized returns on those. And for those, when they want to try to bring that to a larger audience, creating that brand, and in this particular case, humanizing or commercial, sort of humanizing or contextualizing how AI is going to fit into the consumer-facing side of the ecosystem of the world is going to be incredibly important. I think it's going to it has the potential to play a huge role there.
Chris, can I ask a question? Can I jump in? All right.
I was about to call you, Nico. Yeah.
Diana showed this incredible statistic at the beginning, and it's in the report about investment in B2C and consumer-facing companies really going down to the lowest level we've ever seen from a VC perspective. At that same time, you're mentioning that from an IPO, if you look at the IPO landscape, you look at listed companies, a lot of the consumer brands have huge amounts of value that they've generated, and their enterprise valuations are very high. Isn't this kind of, why doesn't that make VCs more interested in doing consumer-facing investments? What's holding them back from your perspective?
Yeah, well, I think a lot of it has to do with the timing and the cycle. The reason there were all these, if you were to look at why were there all these companies that were very, very successful on the consumer side, there are a number of reasons, but one of them was the evolution of what you want to call the Internet 2.0. So mobile, the social networks. You had the ability to, for the first time ever, directly target people on Facebook. And your ability to actually sort of personalize that. So you actually had the ability for companies to start and get to $10 million in revenue on a shoestring, but on a relatively low budget in a way that you previously couldn't. We've kind of, as sort of pointed out by some of the slides in Diana's presentation, where costs have gone up, that wave is played out in terms of sort of where the returns are. But where you will see, as I said, I think this next wave is companies that are going to, create sort of new solutions based off of sort of a backbone of AI that you'll end up having those opportunities. Because when you look at those big winners, they're category defining companies. They are the Ubers, they are the Lyfts, they're the Airbnbs, Pinterest. These are all companies like there's not room really for a third or fourth player in that space. And so then now that those categories have effectively filled, in this particular point in time, I think VCs struggle to see who's going to compete with them and get those different returns until the business model or the product offering fundamentally change.
So Chris, don't tell anybody about this new opportunity because we want to take advantage of that from a media perspective.
I think there's going to be, like I said, I think there's going to be a lot of really unique opportunities that come through. I mean, if you think about what generative AI can do for consumer products, it's going to be huge. And the ability to do personalized storytelling. How do you communicate personalized storytelling, and how do you do that at scale to an audience that isn't necessarily familiar with it? And I think that's where sort of the normalization or the brand awareness that media can provide is going to be really valuable, because it's going to make people realize that maybe I do want generative AI in my day-to-day life, because this is the benefits or value I'm going to get.
I want to talk about what lies ahead, and this is actually a perfect setting. But before then, I do want to also announce that any questions anyone can have, please put them on the chat, or we could probably even go into a debate immediately as we finish off. So we do want to allocate about 10 minutes for questions at the end. Please do ask. Alex, I'm turning to you now. We know that a lot of these deals, actually 90% of them, have some form of TV. So TV is quite prevalent across media for equity investments. I'm quite curious, where do you think the next opportunity will come? What kind of channel, medium could potentially benefit from media for equity investments?
I mean, the short answer is all of the above. It's all about product channel fit. That could be social media, connected TV, out of home, influencer marketing, podcasts. So I think as companies find success in TV, there's every reason to believe they'll find success in other channels.
Nico, I don't know if this is the same with you. We normally get, when we have conversations with founders, I think 2 in 5 founders would ask about influencer marketing. Our last investment, the first US investment we completed last week in a golf brand called LA Golf, it's actually backed by golf players and celebrity golf players. Is that something that you notice as well among founders? Do you see this uprise of celebrity endorsement and influencer marketing?
Definitely. I mean, most startups actually ask us about that, and I think media for equity is a model to have a long-term relationship between reach and a brand. And that's what influencers love that. So I think this is also something that we can definitely expand into the influencer space. I think it naturally fits there. But I would like to kind of underline what Alex said as well, is that I think that there's a whole set of different media channels that work with media for equity. And it really also depends on the startup itself. What are the requirements that the startup has? So we have a lot of different kind of media types, but only a subset of those will work for each startup situation. So it really should be, looked at individually. And it's exciting. I mean, there's also such cool overlaps. For example, recently a startup told me, let's do an out-of-home campaign. And I want to be on those posters throughout the city. But then I'm going to put my influencers in front of the out-of-home posters, and then they're going to mirror that into their influencer reach. So people are really thinking creatively about how to combine different media sets and different approaches.
Yeah, how to turn that from offline into online conversation. We see that a lot with out of home. And I think one way we're looking at what's coming up next, and also even for us as we diversify the media stack, I think it's also about that multiplier effect. We're seeing a lot of brands, like more like CPG brands that have products, right, that will be in a brick and mortar store. And I think the opportunity of marrying a retail partner with TV and doing addressable TV around points of sale, I think this is fantastic. I think this can give a fantastic multiplier effect to that brand. So it's a very interesting space. I think we will see a lot more players. I think retail media is going to play an increasing role. And I've been sitting on this slide for way too long, but this particular finding, again, came out of the research, but I want to challenge this. I want to challenge our own research for a bit. 73% of the fund managers said that educating the startups about the benefits of the model is one of the biggest challenges. And I would ask, is it actually the challenge? Is it the model, or actually making the case again, bringing back what we call brand advertising? And I would like to finish off the conversation with this. This is an open question. I would love your view on this. In any particular order, Tim, perhaps. Sorry, I'm calling you out because you're a founder and you took this bet early on. But I think for you probably was more about really understanding the value of brand advertising and then the benefits of the model. Quite curious how you thought about that.
I think the starting point was, as I mentioned, the starting point was that we were pushed to give it a try. We did know that the branding side of things was really important for us as a business, because we didn't want to have that reliance and on a platform that could sort of change the situation or the context for us. I do think that this is becoming more and more of an important thing, that any consumer company, is building their own brand more, because I think as these various platforms change and shift, it's very hard if you don't have control over your own customer, your own conversation with customers. And I think, so some interesting data, and of course, various data points can be skewed to tell a narrative, but I think that directionally this is true, which is that Google's CPMs are growing at something like 60% year-on-year CAGR for the past 3 years, which is where's that coming from? It's basically coming from the consumer brands P&L, and so I think that it is important more than ever to be building your own brand and having your own narrative, and being able to talk to customers directly. And that's what I think brand advertising enables you to do.
Alex, Nico, do you want to add to this?
Alex, you want to go ahead, or should I?
You go.
So I think, Diana, you're right about kind of interrogating this slide, because what I don't like that much is the word educating. So because what we need to have is a two-way conversation between the founders and the media groups. And that's really important. It's not about telling them something and then that's the truth, but people have to kind of find it out together. And I find that the most innovative startups are not just innovative in their product and innovative in their business model, but they're also innovative in how they do marketing and how they build up their reach and how they have conversations with their clients and users. And the more innovative you think about this, the more likely you are going to tie different types of media types together and make them work for you. So it's an exciting two-way conversation. It's not just a one-way conversation.
And I would just say, having been in very large companies, I would think the biggest challenge is explaining to the sales department that deferred revenue is still revenue for the company. And, that is an innovation in very large companies is much harder than it is in very small companies.
I think there's still, and this is probably a subject for a whole entire separate debate, but there's still challenges when it comes to measurability and making the case sometimes, right, for more traditional TV campaigns. It is actually one of the challenges that it's cited all over the report as well. As well as creatives. I think that's also another topic. I think a lot of people do undermine creatives, and sometimes they don't work, and we're wondering why the company is not working. But I think it's the whole measurability aspect, right, of what we call mass media channels. And I think it's a lot harder, especially in a short period of time, right, to prove that, apart from initial website traffic, going up and people inquiring. But where is the bottom line, right? Impact on the bottom line revenue.
I think one thing that in turn that I think founders are getting to understand better is that as the companies get bigger, that the cost for that incremental customer is going up almost exponentially. It used to be, there was like sort of this conventional wisdom at one point. You would get sort of some one of the perceived sort of pieces of wisdom is like, well, when I raise this growth round or this round, it's going to get into marketing. I'm going to be able to spend more. My cost of customer acquisition is going to go down because I get more efficiencies of scale, et cetera. And what everyone's realized, in the years since then is that the opposite is true. Your first customers are by and large your brand advocates, your cheapest ones to convert. And so that as you start going through these traditional channels, every incremental person is actually that much more expensive because you're going from the I've got to have this to maybe I want this eventually to I've never heard of this product and so on down that customer adoption line. And they're realizing that the cost benefits for something that does accelerate that reach, like sort of traditional media, helps solve a lot of that problem. And so that crossover in terms of cost effectiveness comes a lot sooner now than it did before. And I think, Nico, this goes back to your question about why do people not see that as much? Customer acquisition costs are really, your math as a traditional consumer brand, if you're not thinking about LTV to CAC every single day, you're not going to be in business very long. You have at the extreme end, you have gaming where in certain cases you have companies spending 90 out of every $100 on marketing because they need an incremental customer to come in. That's not sustainable for most businesses.
I absolutely agree, Chris. And what you just touched on right now, the benefits of adding brand advertising to your digital channels. There's a lot of great case studies inside this report, which look at the impacting your cost per acquisition, the trust factor that comes with it. Nick already alluded to that in the beginning, especially for sectors that need that trust or they need to build a new category. Marketplaces as well, in particular, when you have to build both sides of the platform, and even distribution, right? I mean, a lot of these brands starting early on, they need to build a distribution. They also need to signal success to investors. I think there's a lot of benefits perhaps that it may not be so obvious. We're gonna wrap up here the conversation, which has been absolutely fantastic, and I want to thank all of you for being part of this debate. I do want to mention once again, if anyone has any questions, you don't even have to drop them in the chat. Just unmute yourself and please feel free to ask. This report is now live. It's been released this morning. Everyone will get a copy in their inbox in the next hour. And I would like to also ask for a favor from everyone. If you find this interesting, if you have questions to ask, even after the webinar, please do email us back, and would appreciate also sharing this with perhaps somebody that should know more about this, whether it's a founder, investor, or other media executives as well. Thanks, Maria. And you can also download the report. We have the link on the chat as well. I'm going to stop sharing my screen so I can finally see everyone. Okay, if there's no further questions, there always has to be a brave person that starts with with the initial question, and then others will jump in. But if there's no questions and everything was so clear, we can stop here and give you back 5 minutes. All right. Thank you all so much again. Thanks, Nico, Chris, team, Alex. Nico, if I didn't mention you, sorry. Yeah, really appreciate it. It was a great conversation. We should be doing more of this. Thanks a lot.
Thank you, everyone. And thank you for listening, everybody out there.
Thank
Bye.
you.
Thanks a lot.
Bye.
Bye-bye.
Bye.